line at 351-5357. You can also email your questions to talk@wdws.com. We also want to welcome those tuning in on Facebook Live. Though, Ryan, you tell, it is working. Okay, so if you're on Facebook Live, we do get a number of people that actually watch the show. It's important to recognize that past performance is not an indication of future results. You should not make any investment decisions without first consulting your own financial advisor, conducting your own research and due diligence. Well, guys, Fred, there's plenty to talk about.
Right.
So, one of the things I really wanted to get at is a couple of things. One is so much money in negative interest rate bonds. I want to talk about that and what it means. And I've read some interesting articles that have some pretty interesting theories of why that may hang around a while. And then I want to get into, because there's so much worry about the yield curve being inverted, which just means that long-term rates are lower than short-term rates. And then that supposedly portends a recession, at least frequently. And then it implies, and so a lot of people, since we're always fighting the last battle, seem to look back to 2008, 2009 crisis and wondering if we're in on that. But I read an interesting article by Ed Yardeni, who's really good. I think he does pretty good work. In his article, they said there were, in the Washington Times reported on July 29th, the latest estimates that approximately 30% of the global government bond issues are now trading in negative territory. That is, actually, you're paying the government if you buy their bonds, which is interesting. You have the 10-year Treasury inflation protected securities, which is the inflation adjusted cousin of the traditional 10-year Treasury. Basically, that's at essentially 0% rate. So it's almost implying there's no real return in that instrument. And then the part I thought was kind of interesting, he wrote, why should the real bond yield be negative or even zero, like it is around so many places in the globe? And it says the most widely accepted notion is that the real bond yield should be, and this is, I'm going to have you explain this, the real bond yield should be related to the growth rate and productivity, which is the economy's real return. And then he goes on to say, in any event, productivity growth has been turning up over the past few years, but productivity has been growing faster in the U.S. and G7 economies. Is there any way a layman can understand that or is that maybe too technical for even the show?
It's probably not. Layman probably isn't anyone can understand it. No one knows exactly what the reason is. Obviously, one part of it is the fact that inflation expectations are very moderate now. So that's one thing. There's another issue, which is kind of a technical issue, which is kind of an aside here. People maybe ask themselves, why would someone take a negative interest rate when you could just deposit your money in a bank or something of that sort? And the fact is, for huge amounts of money, you can't ensure by just depositing in a bank that those deposits are going to be guaranteed. So buying a bond from the government is a way of, in a sense, guaranteeing it that you couldn't do otherwise. So that's one reason why people would pay.
In other words, better than a potential loss if you're fear of losing money,
right.
If that's the safe haven.
Right. But again, the growth rate obviously is more than that. You'd expect this to normalize at some point, but we've been talking about falling interest rates for 20 years now, and everyone says, well, they can't fall any further. So, and that was really emphatic about 6 months ago or so, and now they're actually falling again. So it's really a kind of unsolved mystery about the economy, because right now we have huge deficits being run at the federal level and close to zero interest rates, and yet there's no inflation. So that's sort of the puzzle, and I don't think anyone knows the answer to the puzzle right now.
He goes on to write that demography is destiny. The geriatric trend in global demographic profiles does support a case for negative nominal and real interest rates if the trend leads to a combination of slow growth and deflation. That's if deflation reduces the value of assets purchased today. And then one final thing, negative interest rates on the debt might reflect the voluntary self-extinction of the human race attributed to the collapse of fertility rates around the world. Dwindling populations, particularly of younger people, will put downward pressure on real asset prices because there will be less demand for goods and services they provide in the future. It's interesting. I hadn't really even contemplated that, but there's part of that that intuitively sounds sensible.
Right. Well, it's sensible to an extent, but whether that makes them negative or not, I think it's an explanation about why interest rates are low, but not why they're negative. The problem now, though, is that the hope in the past has been that developing countries, which have higher population growth rates, would kind of make up for the slack, and that may or may not be happening right now. And again, two of the major countries now, China and Japan, both are not expected to grow a lot in population. Japan's actually declining. So the old story was, well, in the United States or France or wherever, there may be a growing number of aged people, but you simply don't invest there. You invested in someplace else, and someplace else now is probably getting tougher and tougher to find.
I think it is, but it's I mean, it wasn't 3 or 4 months ago, people were talking about a 4 to 5% 10-year treasury, and people were worried about that. And suddenly we're back down to a 1.5% treasury. One thing's for sure, it seems to me, at least, I know maybe it's not for sure, that our interest rates are somewhat tethered to international rates, and those rates are negative to zero.
Now, there is
seems like that tether is tightening a bit.
And there's also slowing growth and maybe even close to recession in some foreign countries, which may have an effect. The other thing is, it's kind of an odd thing. You usually think of the Federal Reserve and the Treasury working together, but now to a certain extent, the Federal Reserve is trying to offset the damage done by the trade war issue that's driven by President Trump. So they, in the normal kind of situation, you would hope they would work together, but now they're trying to offset the economic impacts of reducing trade by having lower interest rates.
So what's your take on it's certainly this? I will call it a war on trade. Is certainly sped up. It's certainly getting it's increasing at an increasing rate. It seems like this tit for tat maneuvering.
Yeah, and then both sides too. It's kind of a strange thing if you ask who are the proponents of this. One is Elizabeth Warren, the other is Trump. So you have both.
So you say both extremes.
But I think the thing that, again, Trump doesn't want my advice, doesn't want anyone's advice, but negotiating a trade deal is not the same as negotiating a real estate deal. A real estate deal, you're dealing with one person. You can make threats and demands and all kinds of things. And once it's over, you go right along and back to where you were. But when you're negotiating a trade deal, you can't say on Friday that we need to withdraw all our business from China, and then on Sunday say, well, I was just threatening, and it may not actually happen. So you can't go back and forth all the time on these issues without causing a degree of uncertainty, which is really damaging for the economy. So again, a real estate deal, no one cares whether the seller and the buyer are on edge about whether it's going to go through or not. But when the whole economy, both the United States and other countries, are on edge, that really makes a difference.
So it sure seemed to me that is creating additional uncertainty. And if I'm a CEO of a Fortune 100 or 500 business, it's certainly making, or maybe the CFO too, it's certainly, which is the chief financial officer, it's certainly making it hard to do any long-term planning, isn't it?
Yeah, you're not going to say on Wednesday, I think I'll build a new steel plant or hire more people or buy more machines, and then 2 days later, that's off and you're not doing it, and another week you're doing it. So we have this kind of weekly volatility based on what seems to be a kind of bargaining.
Is there a basic confusion about the idea that countries really don't trade with each other, individuals trade with each other? It's really, if I buy my Lexus, I'm the one trading with Lexus. It's not really America trading with China or Japan or.
Well, there are allegations, probably some of them true, about China behaving in less than good ways, but a lot of that has to do with the theft or transfer of intellectual property improperly, which is not really a trade issue. And some people, if you're trying to put a good face on Trump's maneuvering, you could say, well, maybe he's arguing about tariffs when he really wants to get him to stop intellectual theft. But I don't think that's really the case. I think it's more just the basic mistaken belief that trade somehow is disadvantageous to both people. And again, like you said, it's trade between people, and all trade to a certain extent is voluntary. So if you and I trade, I sell you something and you buy it, we're both coming away better. And how do we know that? Well, if we weren't coming away better, we wouldn't engage in the trade. So again, trade is mutually advantageous. There are issues about who gains and who loses from it in terms of not every single person gains when we have open trade, but certainly it's good for the economy overall. And as we see, 2 years ago, you go around and ask people, what about international trade? And they say, well, it's really hurting our economy. Now you'd have to go a long ways to find someone who says that reducing trade's a good idea. Farmers, U.S. manufacturers who want foreign imports as part of their production process are all being harmed by this.
Well, I think to me, it's going to be the case that President Trump is either the best poker player on the planet, or this is going to really get ugly and fast, and it's going to just blow up in his face and in our face, unfortunately.
Well, it's not even clear.
I'm not sure that's going to happen, but I have concerns about that.
It's not even clear what a good deal is. A good deal is not necessarily having China agree to buy a bunch of stuff in the United States they don't want. It's better to have them buy whatever they want and sell us what we want, and have us sell to other places in the world. So again, a deal is better than a no deal, but a deal is not necessarily going to be better for the economy.
It seems like we are conflating, or at least some people in the administration are conflating this idea of technology theft, et cetera, which I think is universally agreed that that's a real problem, particularly when dealing with China. And maybe trying to do that through trade is just, that seems like these are two different. And you've said it, there's two separate issues and probably ought to be negotiated separately and differently.
And again, it's not that you said advisors in the White House. It's really advisor in the White House. Everyone in the White House is against this, except for
Pete Navarro, right?
Pete Navarro, one economist who's probably the only economist in the world who believes that trade is disadvantageous.
So a lot of people are worried that this, that is kind of leading to this uncertainty, which is leading to potentially a recession, which is being signaled by this inverted yield curve. And, is it going to be like 2008? And I'm starting to see the articles pop up. I just saw one this morning that we're going to have a Lehman Brothers type of thing in the next week, I think he said.
Well, no, we didn't, no one predicted the severity of or few people predicted the severity of the 2008 situation. But again, I think there's no particular reason to believe if we have a recession, it would be anything other than a normal downturn, which happens used to be every 5 or 7 years, now every 10 or 11 years. So if there were a recession, it's not necessarily a banking crisis and the government having to step in to support the capital markets, that sort of thing.
Well, I mean, I look at the dissimilarities. We don't have a housing bubble. It was $6 trillion overvalued. If you use cash flow and rents kind of capitalization models, that clearly was an overheated, basically also policy driven, I think, but regardless.
And we don't have a sector like in the late 90s, the tech sector was a similar situation.
Right. The S&P 500 had a price to earnings ratio of around 30 times earnings. We're a third lower than that.
And the NASDAQ
now.
had
100 times earnings practically. In fact, 10% of the stocks in the New York Stock Exchange traded at 100 times earnings. So obviously it's not like that today. And then I think the banking system, the much better capital structure and banks, it just doesn't, and we don't really have the aggressive mark-to-market accounting that really fed into that vicious death spiral. That all those things combined in 2008, 2009, looking back, say, yeah, it kind of as a setup for a real vicious down cycle. I don't see, we seem to be absent all those things. We seem to have a reasonably strong economy. We have and then if we go back to prior recessions, even 87, it was a much different environment from an interest rate standpoint.
The 1990-91 and the 2000 recessions were very modest compared to this recent one. So again, we also probably should distinguish between a slowdown and a recession. The economy probably is slowing down, but a slowdown is not the same as a recession. A recession is where the economy is contracting, a slowdown where it's not growing as fast as it was previously. So it's natural that we'll probably have a slowdown. The other thing which we have to remind ourselves of is that we're not running a machine like a airplane or something where we can adjust the controls a little bit and go up or down or whatever. We don't really have this kind of day-to-day stability. So fine-tuning is really a kind of silly idea, but we're doing that. If the Fed reduces interest rates by 1/4%, that's really nothing, but it suggests they're trying to fine tune the economy.
It is kind of amazing. I think we continue as a society to underestimate just how complex capital markets and how markets work. and the billions of decisions on a daily basis that have to seem to come together to make all non-planned, really.
Right.
And to think that, it's kind of like fatal conceit that we can go in and tinker with these things and make them better. It's certainly an interesting environment. It certainly doesn't remind me of 2008, 2009, or even any of the past recessions. Even if it was early 80s, we had they took interest rates to 19% to shoot inflation in the head. 87 was different. We had much higher interest rates than today, some closer to 6%. Now we're talking about a 1.5% 10-year treasury. It seems like everything's missing for. Doesn't mean it can't happen though, right?
Well, I don't think
still horrible things can happen, and we just didn't see it coming. So,
well, I don't think I think obviously there will be a recession at some point, some time. Most people think it won't be this year, and a higher probability next year. So it's not that there won't be a recession sometime in the next few years, but the recession is unlikely to be the magnitude of the 2007 to 2009 situation.
Those are. Though I do tell clients, just because I have my theories doesn't mean we can't start one tomorrow, just like it, for different reasons. But they do seem to be kind of once in a lifetime, or at least an investor's lifetime situations. It seems like earnings from a corporate America standpoint, they have slowed down a bit. They've kind of dialed them back, but they're still positive. But for 2020, it's still kind of the consensus that earnings will rise. So really, we start thinking about next year already. It's a discounting mechanism, and kind of the consensus is earnings will be up 11%. So, I mean, that's a pretty positive sign. That's subject to, to change. And then, of course, we still have a really strong dollar, and they say that's hurting American companies in some ways. You want to explain that? How a rising dollar sounds like a rising dollar to most people. That we want a strong dollar, but how does that impact?
Well, it's different for an individual versus the country. A strong dollar means that if you buy foreign goods, you're buying them with dollars, which have more value in foreign countries. You can exchange them for foreign currency at a better rate. So if you're traveling, going on a vacation in Europe or Asia, a strong dollar is advantageous. If you're buying something from foreign countries, it's advantageous. But on the other hand, the other side of the coin is when you try to sell things, American goods are more expensive. So the strong dollar then means it's more difficult for exporting goods from
half of the Standard & Poor's the biggest 500 companies in America, half their revenues and sales come outside of the U.S. So it really kind of means if my sales internationally go up 5%, but if our currency goes up 5%, I really have zero increase in sales because
that's one of the reasons why for a while international stocks were doing well, because of the fact that the dollar was
weakening.
So again, it's hard to again, people probably are confused. You might think, well, a strong dollar is good, a weak dollar is bad. And the answer is a dollar is a price. It goes up and down, and there's no particular level that's the ideal one. Is simply,
unless you're China, then you set your own.
Right.
But you're right. It's just, again, it's that voluntary exchange every day, every second of every day is determining the price of the value of one currency versus another.
But obviously a high value dollar makes it difficult for exports. A really weak dollar means there may be something wrong with the economy, like Argentina or Brazil in the past. So you don't want a dollar that's plummeting. But on the other hand,
is this what you economists sit around and talk about when you're all together?
Well, actually, not much. Monetary economics is really complicated, and
it changes, doesn't it, from administration to administration? But certainly over a decade or two, you can really have pretty radical shifts in monetary theory.
Yeah, right. And also the what used to be abnormal now has become normal again. 20, 30 years ago, people would say we can't continually run a trade deficit. We can't continually run a huge deficit at the federal level. Yet we're doing that, and the economy seems to be surviving.
It's easier at low interest rates. Why are we not issuing 100-year bonds or perpetual bonds in the U.S. if we can do that at 1 or 2%?
It's probably more an institutional thing. But again, in the past, we've talked about the short-term interest rate being negative, which is not surprising. But now we're talking about in the United States, maybe up to 10 years, other places, maybe 30 years of basically zero interest rates.
Right. If you have that, why not issue your debt for very long term? It's not as an asset play, it's just more of an insurance policy against rising interest rates. I don't even know if there's any talk of anybody doing that.
The other issue is if we really do have an infrastructure problem, borrowing money at zero and investing it in a positive return infrastructure is a pretty good deal at this point.
Okay. Well, now we're going to switch to a little bit on get to retirement planning. Of course, at Rudy Wealth Management, that's kind of that's our niche. That's what really we talk everything retirement. That's our language. And so the guys wanted to talk about that. And retirement is not an easy process as far as, trying to do the planning for it. It can be rather complicated, but it seems like when we really think about the critical time period, it's between the 50s and 70s. There's a lot of big decisions that are going to get made. I know that Paul Jr. recently wrote a blog about this, about the important ages, and I would call them stages also, of retirement, which you can get at rudywealth.com. The first is age 50. So that's kind of like when Paul was writing about age 50, and frankly, I haven't read it. You guys write a lot of blogs, so I can't read them all. The first one is 50. So Ryan, and then we'll go to a call here just in a minute, but I'm going to tee you up. What is the trigger about 50?
Well, at age 50, there's a catch-up provision for any of your qualified accounts, which would be your 403b, your 401k, your IRAs. It simply allows you to start contributing more or saving more to those types of accounts once you've reached age 50. I think the mindset behind it is probably for most folks, not everyone, but you may have been spending more in your younger years. You have kids. It's harder to save. That's just a simple fact. And as you get to age 50, the government gives you the allowance to then contribute more into those accounts. And for a 403b and a 401k, you can contribute $19,000 a year up until that age 49. And then once you hit that magical 50 year, you can start adding an extra $6,000 per year. So you have a total amount of $25,000 you can contribute in your 401k or a 403b. It works the same. And then for the case of an IRA, normally you can contribute $6,000 per year, and there's a $1,000 catch up to allow you to contribute $7,000 total once you're 50.
Okay, we're gonna go to that in a minute. We're gonna head back to that. We're gonna take call in a second. The next thing I'm going to ask you is kind of when you're halfway through your 50s, you get another little perk in 401k accounts that a lot of people that are thinking about retiring, particularly on the early side, might think about. But we're going to go to Stan. Stan, how are you today?
I'm okay. Thanks for letting me talk on the air here a bit. You're talking
a bit
about
now, just a bit. Go ahead, Stan.
Well, you've got,
I know.
What is it, 30 minutes I can talk?
Well, Stan, I think there's probably 8 hours you could talk, but go ahead. Well, I'm just poking at you a little bit.
That's true. I'm just poking at you. I'm teasing too.
That's okay.
It's all good. Anyway, you're talking about having 100-year bonds. You probably remember that back in the late 90s under the Clinton administration, we stopped selling the 30-year bonds.
Right.
And we were on track to have a zero national debt within 15 years. But that was blown out of the water by the Republicans. And, I really think that that's something that people need to think about.
Which part, Stan? Those darn Republicans are issuing long-term bonds.
The Republicans running the national debt up.
Well,
Every penny of national debt we have right now is due to Republicans.
Well, I think there's a lot of people would argue with that. I think it takes both sides to vote for a lot of these things, Stan. I think they're equal opportunity spenders, but I would agree with you. And looking at historically speaking, the Republicans do a finer job at spending. As far as amount spend, they do tend to spend more.
That's good. How about this? 401ks. As when I was in the business, I had very, very, very few people that could do $2,000 a year. Maybe it's just because I dealt with much lower income people, but I had very few. So when it said that we can have a contribution to your 401k of $19,000 or whatever it is, that really just is out of most people's reach.
Yes, Stan, but let me give you my experience for 35 years of dealing with, I call them the millionaires next door. I think of how many clients I have that worked at Kraft if they graduated from high school or right out of high school, put in their 30, 35 years, lived in a modest house the whole time, were frugal, and they saved money. I don't know how much they saved in any given year, but so I would agree that for most people, the concept, I think that's fair to say, Fred, for most people, ability to save $19,000 a year is probably out of reach for a large number of people, but it doesn't mean they can't save 1,900 or 2,900 or 3,900. There's always look, and I know depending on how you grow up, what your career path is, it's tougher. Some people have a tougher life struggle than others, no question about it. But I see
you're
every.
Absolutely right on that. The magic of compound interest is what makes the millionaire next door.
And I've seen it walks into my office once a week at least, somebody who's done it there. You look at them and thought, how did this person that in their best year never made more than 35,000 a year? And I'm not making fun of that. I'm just saying that was just their life. Raised 2 or 3 children, educated, maybe some of them or all of them. And yet they walk in with $700,000, $800,000, $900,000 from their 401k plan. Part of it was a match, of course. There's that going on too, but most of the time is just slow, steady accumulation and deferral and spending, putting it aside before it hit their income stream and letting, as you said, Stan, the pure magic of compounding with the proper investing. And that's another issue. Anybody can do it, but I would agree. I think it's fair to say, go ahead, Fred.
There's another way to play this. People may have accumulated assets outside of qualified plans, and you could convert those assets into a qualified plan. And even though you're not generating $10,000 or $15,000 every year, you may have enough to do that for a few years to get it from a outside situation to an inside situation with the 401k or IRA.
But we know most people, for whatever reason, have a tough time saving, because when half the people that draw a Social Security check, when that's 100% of their income for half the people, it tells you that there's a whole part of society that, for whatever reason, I'm not going to name political reasons necessarily. Some of it's just life is tough, and and for certain occupations and certain people. So it's a reality, but I've seen an awful lot of people do it on very modest means. And I've seen people that had high incomes spend a lot of money, and they still dart like minnows on a treadmill because they're so nervous.
Yeah, I agree with both of those comments, and I hope you guys have a great day.
All right, Stan, thanks.
The other thing I think I'd add for the lower income people is that you don't need to save nearly as much to replace your income. So first and foremost, Social Security is going to replace a bigger portion of your paycheck.
What do you mean by that?
Well, Social Security, the way it's designed is that it basically replaces a higher percentage of lower income thresholds. So the benefits are based on it's called average index monthly earnings, but just think of it as like inflation adjusted earnings.
Yep.
And there's tiers. So it's like the first tier, they replace 90% of your inflation adjusted earning
up to a certain level.
Up to a certain level. And then it tiers down from there pretty quick, pretty substantially.
Right. And those are called bend points. But.
Right. So Social Security will replace a bigger portion, and then the remaining portion is going to be a lot smaller. So you may not need this giant investment portfolio if you only need $10,000 or $15,000 a year from your portfolio to supplement your Social Security income.
So in simple terms, someone who's historically inflation adjusted made 6 figures, 100,000 a year, and spends 75 is trying to replace maybe $75,000, of which a smaller amount is going to come from Social Security on a relative basis. So they actually have to increase their savings beyond the person that has the lower earner as far as what they need to save on a replacement basis.
Yeah. So I think that, the takeaway is just don't be dismissive of, oh, well, I can't save anywhere near these maximum amounts. Well, most people don't need to.
And I think this is part of this retirement planning, because a little bit later, if we have time, I'm going to go into a couple of surveys, and it's just a lot of people let a lot of things get in the way, but I know life can be tough. Getting back to retirement, now we're in our mid-50s, Ryan. What is the one thing that people might not be aware of if they're contemplating early retirement, maybe before 59 and a half, that they might want to think about?
So this is what we call, I think, the golden 55 rule. So at age 55, if you have a 401k or a 403b plan, and you separate from service, which could be any number of things. If you get laid off from work, if you're fired, or if you quit, or if you just simply choose to retire at that age, if you have the resources to do so, you can take withdrawal from your 401k or your 403b without incurring the 10% penalty, which is normally assessed to a 401k, or I should say like a IRA, if you take the money before that age 59 and a half.
So you have
So-
to be 55 though.
So you must be age 55 and you must separate from service once you've reached age 55. And assuming you meet those two criteria, you can then again take the money out of your 401k or 403b without being applied that 10% penalty. You still, of course, have the taxation on any distributions.
Right.
That's always the case, but you don't receive that extra 10% penalty for an early distribution.
And,
So-
and I would add, I don't think a lot of people are aware of this rule just based
I
on what
agree.
I've seen talking to people who are coming into our office. And it's easy to make the mistake of, oh, if you're retiring early or if you're laid off and you're going to stay retired or whatever, the like reflex answer is, oh, roll over your 401k to an IRA. But this is a reason why you may not want to just automatically roll your money out of your 401k into an IRA, because if you do that, then you're going to have to wait till 59 and a half to get your money out penalty free.
There are
It
some
is-
other paths to go if you have an IRA, but
That's
it's
true.
really, there's a lot of constraints.
More
It's somewhat
limitations.
complex and you can really make mistakes. So ideally, if you think you're going to retire before 59 and a half and you're in a qualified retirement plan, you want to make sure you talk to an advisor before you do any rolling over yet, Fred.
It's also a double-edged sword. You can take the money out and buy a boat or something too. So it's
Right.
It's not, you lose the discipline of the 55 limits.
Yeah, some people need those forcing mechanisms to keep them responsible, but assuming you're going to use the money responsibly.
And then there is that 59 and a half age. So once we're talking about being in our 50s, now we're in the last year of our 50s, and then it does change.
Yep. So at 59 and a half, you can take your money out of your 401k, your 403b, or your IRA clear. You don't have that 10% penalty, but you can take the money out starting at that age. And one thing I do want to add, just going back to the golden 55 rule, is there are planning mechanisms. So if you have maybe a couple of 401ks or 403bs you've acquired from maybe working at different companies over your entire career, there may be the opportunity for you to consider rolling your old 401k, your old 403b into your current plan. So you can take that money and allow it to then be applied to that age 55 rule, because you're not able to use a former 401k or a former 403b money at age 55. It has to be that current one. So that's a really good option for folks, provided your plan allows roll-ins from an outside plan.
Is there a window about how much time you have to do it once you separate?
I think you have to do it before, but although I can't say 100%.
So yeah, I mean, you want to do it. You want to make sure that you're 55 in the year that you're going to fully separate in order to take advantage of that. I mean, that's the key thing. And the key thing is to talk to your CPA or your financial advisor just to make sure that you're following the rules exactly. But just, it's important to know that there is this golden 55 rule, which is really centered around for certain qualified plans, 401ks, 403bs, et cetera, that allow you to retire early before 59 and a half, as long as you reach the age of 55. So it's a planning strategy. Then we move into the 60s, where Social Security and Medicare suddenly become a factor, David. Social Security, what do you find people's views of when they think it starts, as opposed to, well, what do you think the most common touch point is?
Right. Well, the earliest age you can claim Social Security is age 62. So I think at the very least, you want to start thinking about analyzing when you're going to claim Social Security at that age, because I guess there's a chance you could claim it right at 62. And that's what most people do, just to be honest. I'm pretty sure there's data on that most people claim at 62. The downside to doing that is then your benefits are reduced. So you get to start your benefits earlier, but depending on when your full retirement age is, which for most people nowadays is 66 to 67, somewhere in that range, it could be 25 to 30% less than if you waited just till your full retirement age. And it could be even quite a bit less than if you waited until like age 70.
And if you're around 60 years old now, your full retirement age is going to be around, what, 66 and a half-ish?
I think so. So it's based on age. So if you were born between 1943 and 1954, it's 66. And then it scales up in 2-month increments for every year after that.
Okay.
And then if you were born after 1960, it's 67.
Okay.
So we're getting to the phase where most people are going to be at 67.
Okay. So looks like I have to wait till, well, I don't have to wait, but it looks like full retirement age is beyond 66 for me, Fred. And explain to people this idea. I know it really wasn't part of what we were going to talk about today, but I think it's so important when you talk about it, people seem to relate to it. This waiting, if you can, delaying your Social Security, maybe till even for one of the two of a married couple, maybe the higher earner to age 70, You talk about how that offsets some of the normal risks when you think about retiring.
Yeah, so the way I think of it is, what's the worst case scenario for a retired investor? It's high inflation, because now you have to basically withdraw more from your portfolio to fund your lifestyle. Low investment returns, or a poor sequence of returns, just bad returns in the beginning, and a really long life. Well, what are things that Social Security helps with? Well, it helps with all those things because it increases with the rate of inflation. It hedges against high inflation. So that's that much more of your income that is going to be perfectly going in lockstep with inflation. It hedges against poor returns, because if investment returns are really bad, it's nice to have this Social Security income stream that's bigger. You're relying on investment returns less from your portfolio for less of your income. And then it also continues for the rest of your life. So,
and then even for the spouse, there's some longevity insurance in that way, isn't there?
Yeah, because what happens is, at the death of the first spouse, assuming you've got two who are eligible for Social Security, that surviving spouse is going to get the higher of the two benefits. So if one person delays and their benefit's bigger, and then they die first, or if they don't, if the other one dies first, that surviving spouse is going to have a higher benefit. So it's like it hedges against all the things that really are kind of tough for investors.
So all the things people worry about as an investor are basically a part of the cure is delaying your Social Security as long as you can stand it.
Right. And then the obvious risk that you run is, okay, I'm delaying Social Security and then I die before I even get benefits, and then you got nothing. And so that's a major concern for people, and that's what people that's what keeps them from doing this.
And I think that's why we see so many people almost default to claiming it early or as soon as possible, because of this fear of, what if I've paid in all these decades of hard-earned work and I get nothing from it. And I think that's kind of what psychologically people get nervous about, and they just take the earliest they can to start receiving an actual dollar in their bank account to show that they got something out of Social Security.
Right. And the way I look at it is, you want to look at the odds. It's like, okay, well, what's the likelihood of that happening? Yes, it could happen, but it's a very low likelihood. And am I going to make a choice that is suboptimal the vast majority of the time, so that I'm better off that 1% of the time? I don't think that really makes sense. Plus, the other thing I look at, which is a little bit morbid, but it's like, I'm going to be dead, so who really cares? You know what I mean? It's like, it's unfortunate, I guess, for your heirs, because you spent more money along the way. But for most people, that's not their number one priority. Is just leaving as much money as possible to their kids.
So that's what you mean by who cares? You're dead. You're saying if you delay it and use up more of your assets in the meanwhile, to live on until you get Social Security. It just might mean if you do wake up on a cloud early, it might just mean a little bit, fewer assets for the kiddies.
Right.
And halfway through, since we're talking about mid-60s, then there's Medicare.
Yep. So that's age
Medicare
60.
for all soon.
Right.
That's age 65. But you can actually apply basically anywhere in the 7-month window. It starts 3 months before your 65th birthday, includes the month where you turn 65, and then it's 3 months following that. And so I think, just for practical purposes, it makes sense to apply somewhere in the 3 months beforehand, just to make sure that you get switched on to Medicare benefits basically as soon as you can.
And then
even if you're not retired, you have to do a part of it at least.
Wait,
I guess
I'm sitting there reading notes, so I'm sorry.
Okay.
I unplugged here.
So even if you're not retiring, you still have to at least get one part of Medicare.
If you're 65,
Yeah.
yes, because that's going to be integrated with your employer's plan.
Right.
You don't want to not apply for at least the basic part of Medicare at that point, even if you are working. Your employer is going to be very unhappy, and you'll be unhappy because now we're talking about potential penalties that are ongoing if you don't do that. So when people think of Medicare as, I'm retired, but even if you're not retired, as Fred said, and you're working, it's still a Medicare issue when you turn 65.
And if I can add something here to your point, Fred, so if you work for a company that has 20 or fewer employees, Medicare at the age of 65, even if you're still working, is the primary payer of your health care. So you do need to make sure that you're enrolled in Medicare at age 65, even if you're still working, provided, of course, you're working for a firm with 20 or fewer employees. If you're working for a larger company, you can still use your primary insurance that you have through your company. So it comes down to the size of your company, which is kind of a different rule.
And we're kind of on the tail end of the 50s to 70s. Now we're 70 and a half. So we're going to call that 70-ish. There's a lot of confusion about the required minimum distributions and when they kick in and how much they are. Why do you suppose it is so confusing?
I think the rules confuse people. So the normal rule is, okay, we have to start. Basically what it is the government forces you to withdraw money from your pre-tax retirement account so that they can get their tax revenue. And that happens in the year you turn 70 and a half. But theoretically, you can delay it until the next year.
If you're born in the second half of the year. So it depends on what your month is when you turn 70 and a half.
But for practical purposes, it's not usually a good idea, because then you have to take two required minimum distributions that year, which can cause your income to be substantially higher and move you into higher tax brackets and things like that. So I think that's why it confuses people. But at the simplest level, it's just know that, okay, in the year you turn 70 and a half, you're probably going to have to start withdrawing a certain amount from your IRAs. And then usually your custodian will tell you what that amount is, but you just want to make sure that you don't forget it, because the penalties are pretty steep.
But the first year it amounts to about 3.6% withdrawal rate. Now, and then there are some exceptions. If you're working for a company and you're still working at 70 and a half, and you don't own more than 5%, I think it's 5% threshold for ownership in the company. So in other words, you don't own the company. You're just an employee at 70 and a half, and you have a 401k plan that you're still active in. You don't have to take required minimum distribution. So there are some little caveats there. But for most people, they're going to at 70 and a half, they're going to start taking it. And the next year it increases a little bit and a little bit. But for the most part, it's a very sensible withdrawal strategy. It's not one that's likely going to have you depleted anytime soon, if at all, depending on your asset allocation. So it's an important thing to be thinking about, and it's certainly integrated in every single financial plan.
And I think for a good number of retirees at age 70 and a half, you've probably already been taking distributions from your IRA anyway, unless you have such substantial assets outside that you didn't need to use the IRA money. So for many folks, although yes, you are required to take it, chances are you've already been taking it anyway. So it's probably not going to be eating into yet additional income sources showing up that you weren't originally taking.
I think that's a fair point. So suppose you have, $300,000, $400,000, $500,000 in a 401k plan that's now in, and maybe it's in an IRA plan, and you're drawing Social Security. And chances are for most people, they're looking at that bucket of money as not to delay it till I'm 70 and a half. It's, hey, I'm retired at 62 or 65. I'm trying to make the most out of this one life I get with the assets I have. And that's what you're saying. Then part of most financial plans are, okay, how much of this spending is going to be coming from your qualified retirement plans? So you're right. So for most people, they will be probably taking at least a required minimum distribution by the time they're 70 and a half.
And you can always just take the money after you withheld taxes and put it in a different investment account, in like just a normal brokerage account. I think sometimes people feel like, oh, I'm forced to withdraw this money, and then they forget that, well, yeah, but you can just still leave it invested. It's unfortunate that you were forced to pay taxes and you don't get tax deferred growth on that money anymore, but it's not like you're forced to spend that money or take it completely out of investing.
Yeah, I think that confuses clients sometimes when they have been taking money from their IRA on a regular basis prior to 70 and a half. Sometimes they start thinking, oh, good, now I'm going to get extra income from my IRA, but it's always integrated into the plan. Well, as you can see, there's a lot of things, and those are just a few of the things you have to think about when you're planning ahead for retirement. And the important thing is to get help if you need it. Don't be afraid to reach out to a financial advisor. These things need to be handled in advance if you're really plotting this out, and really prior to your 50s. And we were talking about 50 to 70s, but really these are things you can start thinking about in your 30s and 40s, because you also want to start planning on, hey, if I just keep doing what I'm doing, what are my options going to be? When do I get to control my schedule? Some people call that retirement. So these are all integrated. If keeping track of all that stuff seems a little bit too overwhelming for people, well, that's where firms like ours, Rudy Wealth Management, comes in, and we're always happy to talk to people. We always have a no-cost initial consultation, just kind of like, hey, here's my story, here's what I'm thinking about, and then we just listen and we give them our thoughts on that initial meeting. And I think that's very helpful sometimes. And there's many times we can just take a lot of the confusion away, and they can walk out, and we've simplified their mind, whether they do business with us or not. I'm going to go back briefly, David, to someone you used to work with at Dimensional Fund Advisors, Gene Fama and Ken French. Gene Fama is from the University of Chicago and has a Nobel Prize. And Ken French is with Dartmouth University, Tuck School of Business. Two of probably the most published people, financial people, maybe the two most cited financial people on the planet. But with all this excitement, and of course, the news every day is bombarded with recession because of inverted yield curve. I thought it was interesting that finally some academics got up and said, well, is there a strategy to be made out of this from an investor standpoint? Does it make sense? And is it rewarding to basically reduce your exposure to stocks with the idea that the return premiums are going to be lower in the next 1, 3, and 5 years? Is there a strategy to be made out of it? And pretty much this answer was a simple no. Isn't that pretty much what dominated? I mean, as soon as I saw that sentence, I kind of quit reading because they're pretty credible authors.
Right. I think, anytime you hear something on the news or some sort of forecast or prediction by a pundit, you need to ask yourself, what does the evidence actually say? Because a lot of times people have their theories, but there's no real evidence to support them, or it's not good to act on, what they're suggesting. And in this case, I'll read the exact wording was, we found no evidence that inverted yield curves predict stocks will underperform treasury bills for forecast periods of 1, 2, 3, and 5 years. In other words, just because the yield curve is inverted right now doesn't mean stock returns are going to be negative or even worse than what treasury bills do over really almost any time frame you look at in the future.
Does that surprise you, Fred, or just
not really? It goes back to the question of market timing. We always talk about market timing not being a winning strategy. There's a economist joke, which is usually not very funny, but the joke is that this person is an expert. He predicted 9 out of the last 5 recessions. So if you're predicting twice as many recessions as actually occur, you're going to make a lot of mistakes if you're trying to market time.
But if I watch CNBC today, I'm not picking on them other than they're easy to pick on because it's just the constant negative broadcasting company. There'll be 12 pundits on today talking about the inverted yield curve, and that means we're going into a recession, and that means stocks are going to decline. And intuitively, it leads people down that same path of, well, wait a minute, that's the 8th guy or lady today that said that stocks are going lower, I should sell my stocks. But it really ultimately is a market timing strategy. You have to have a strategy to re-enter. And I presume at their study, though I haven't read it all the way through, they must have said, well, when it's inverted, we sell stocks, and when it becomes inverted again and long term, and it becomes more normalized, we'll buy our stocks back. And turned out it was a losing proposition the vast majority of the time.
Yeah, and someone may be, obviously, someone's going to be right sometime.
Of course, like anything.
If there are 1,000 predictors, probably 5 are going to predict everything right for one time, but then the next time those 5 will probably not be correct.
But what I find so fascinating is there's so much time spent on this. And nobody's ever gotten on there and said, well, wait a minute. 2 of the smartest people on the planet studied this. And there's not a strategy or an investment policy to be made out of it. So we can just stop talking about it. But no, they won't do that because, if it bleeds, it leads, right?
Yeah. There are a million little things that never quite work, like the January effect. And I can't remember go away in May and whatever those kind of things. And they sound good, but they don't really work as a trading strategy.
Well, finally, there was an Alliance for Lifetime Income's 2009 Protected Lifetime Income Study. Well, it must be from an insurance company, I guess. But anyway, says the vast majority of working Americans are at least somewhat anxious that their savings will run out during retirement. The top 3 barriers to investing: debt from credit cards, student loans, car loans, and the feeling that retirement planning is too overwhelming. That's another one. They think about 22% of the people. They think, when you think about retirement planning, there's a lot of things that come together in it. I think, in some ways it's so simple, but in some ways there's a lot of complexity to it at the same time, which sounds strange, but there really are a lot of nuances and little quirky laws when it comes to retirement planning. So that doesn't surprise me. And even among respondents ages 55 to 74, the survey found that 57% hadn't calculated their monthly needs. Really common, isn't it, guys? When a prospective client walks in, or we've met maybe even a couple of times, and we ask them, well, what do you think your monthly spend is? It's a rare beast that comes in and says, well, here's my budget for the last 2 years. Very few people can come probably within 20 or 25% of what they actually spend on a monthly basis. sometimes we shortcut that. We look at their tax return and we can say, well, your taxable income, your after tax income after your taxes was 52,000. So, you at least spent that because you didn't increase your savings by the end of the year. But it's amazing how neglected. It's such a big issue. You're going to spend probably 3 decades for people now in retirement. And it's amazing the lack of thought and planning that goes into it. I think people are intimidated to go to financial advisors, and they should not be.
Well, I also think that a lot of people are out there that say, well, I'm just never going to retire. But I don't remember the exact statistics, but the vast, vast majority of people retire sooner than they were planning on, or even people who weren't planning on retiring. They get forced into retirement to care for a loved one. They have a disability. They get laid off and have a tough time going back to work. There's a lot of reasons that force people into retirement. So you don't want to just bank on the fact that you'll be able to work forever. You want to kind of at least be somewhat prepared for that possibility of kind of being forced into retiring a little bit earlier.
Well, 57% of people haven't calculated what they need. There's no way that they have a plan that's going to, if there's a gap, they don't even know that there's a savings gap. And that to me is kind of scary. It also explains why half the people on Social Security, it's 100% of their income, amongst many other things. Sometimes it's just a tough draw in life, and you've had a pretty tough go of it. Well, guys, appreciate you joining me today, Fred. Always had been traveling. You're going to be here next show.
Yep.
Good, because Fred's always traveling. Everybody, literally, not everybody, but there's a lot of people around the country that like to have Fred around just because they like to know what he thinks. We're certainly in that camp. We're always delighted to have Dr. Fred Gertz on our show. I think it helps us immensely. And guys, well, we'll be back in 2 weeks. Thanks for listening to Paul Rudy's On the Money.
Join us for the second and fourth Tuesday of each month for Paul Rudy's On the Money.